The example that I'm going to show you is a gap up situation. It gapped up a couple of dollars, and it doesn't happen too often. It's kind of unique, but I did want to make you aware of it so that you pick up the indicators and the signals that mark this gap up. It is tied in a little bit with the candles being right around the 200 moving average, as you can see right here on the daily chart, or on the candle chart I mean. And the situation in the trend chart is that we're in a sky touch. Trend red crossed over trend green the day before, the vertical green line, and on the vertical green line we have trend red and green both going up, but I'll point out that trend red is not over the zero line like we normally see for the vast majority of gaps in a sky touch, nor is trend green. And trend green is not always above, but we like to see trend red higher. The higher the better, typically. We also, in other examples I've shown on other videos, when power pink and blue cross over power orange, that the following day can be a significant gap. And that's usually tied together with a sky touch that we have here in the trend chart. And as you know, the sky touch is one of the 6 down touches that make up the 3 gap patterns. And while I'm on that, it's real easy to see over here in the price chart from this red peak right here, you have the next day is down and the next 2 days are up. And that's a BOC 2-day pattern. And I counted them earlier, and I think I got 14 or 15 BOC 2-day patterns. So the identical indicator requirement is satisfied with having at least 12 identical indicators. And then when we have the sky touch, remember when we have a down touch, the whole system is built on a price recognition, a price reversal recognition identification system. And so when it down touches something, it reverses and goes back up. When you have an up touch, so it comes up from the bottom and hits a line, then it reacts and goes back down. So it reacts into a downtrend or a gap down. Now, a down touch, there are 6 down touches. 5 of them are going down and 1 of them is going up. The 5 that are going down are when trend red, green, and gray down touch the trend pink, blue, or yellow line, or the zero line. That's 4. And then they can go underneath the zero line, in that area underneath the zero line. That's 5. When they do go underneath the zero line, or if the trio is under 0, then it would be underneath the blue line, because the blue line is at the bottom. Then that area, how it's classified is that the day that it crosses under 0 or crosses under the blue line, that day is then the reversal signal for the next day up. So it just goes down into the area under 0 or under the blue line. There's no specific point that it touches. It'll usually go down between a 1/10 of a point to 15 or even 20 points. But most of the time it's in a range under 10 points underneath it. The 6th down touch is in the opposite direction. It's an up touch, and that's when trend red crosses over trend green. Basically, what I'm talking about here, the trend red crossing over trend green is the start of an uptrend. And so we have 5 lines that we down touch, it reacts and goes back up, and then we have 1 continuation pattern. And that's like trend red crosses over trend green. That's the crossover day, that's the 0 day. And then we also have day 1, 2, 3, and 4. So a sky touch pattern has actually 5 days of possible conditions where you might say the crossover day plus 4 days. So in any case, there are the 5 lines that they can down touch plus the 5 sky touch positions. So there's actually 10 positions that we can down touch, even though 5 of them are continuation patterns, meaning the values and the lines are going up and then there's a gap up, or the values and the lines are going down and then there's a gap up. So again, we're dealing with on day 2 of a sky touch, but again, the red is not high above 0 where it typically is. It's down low. As a result, the pink and blue lines did not cross over 0. They're down low. And you can see that when you look at the fact that red is right where the yellow is, and it's not like above gray or something like that. This example that I'm going to talk about has a lot of DIFF. That's difference or separation differences that we call it. And by that I mean, if you look at trend red is a -9 and trend green is a -23. And that's 14-point separation. Now typically when red and green get above 10, we like to see 11 or 12, but obviously 14 works because we have a nice gap. And this separation that we see between the green and the red is significant from the perspective that that distance is stronger than we normally see it. In other words, red and green run closer together. When they're separated, it causes things to happen because the two forces, which are paired together, synchronized together, running together most of the time, are now separated, and so then you see a huge thing. In fact, if you look the next day, trend red is 132 and trend green is 43, so now you have a 90-point separation between green and red on the gap day. So now I want to go over to the swing chart. We obviously have the sky touch. That's a signal for a gap. The location patterns that we have is that power Zion and the power 4, blue, pink, white, and yellow, are all underneath orange. And that's a normal place for a gap up to be, all 5 lines or the power 5 under the power orange. But note, if you will, that Zion is down and the power 4 are up. And that's referred to as directional divergence. And that's a divergent condition that exists. Also, with power Zion above 0 and the other lines above 0, Zion above 0, the other lines under 0, we would normally think of that as Zion above orange and the power 4 under orange. But the line is so close to orange, that's the way we think about it, which identifies more divergence in location. Because typically when we use the 0 line with Zion and the power 4, there's not as much effectiveness. But I do want to point out that I've seen many of these situations with Zion, power Zion between power orange and power green. And when we have a 2-day event in which power Zion is between orange and green, then a gap can occur. I've seen many of them with this power Zion in between orange and green. Now, it can go between orange and green and nothing can happen because there's not additional supporting evidence to go along with it. But the Zion between orange and green 2 days is an easy way to run a scan on. You can pick it up, or you can identify with how to qualify the scan. And so that's why I bring that idea up. Also, I want to go over to the swing pink chart. One key signal in the pink chart is that swing pink has crossed over green, and that's a major crossover for swing pink with Zion underneath it. Likewise, we have a significant separation in between zip red and zip gray, and I want to show you how to calculate those differences. First of all, if you go back to the day before the vertical green line, zip red is at 49 and zip gray is at 45. And so that separation is 4. Now you go to the vertical green line and you have zip gray at 89 and zip red at 89 and zip gray at 63. Now we have a 26-point difference. 4 times 6 is 24, and 4 times 7 is your 27. Your 28 might work too, I guess. But what I'm trying to say is that you're working on an X factor or a times factor. For you, the difference between zip red and zip gray is a factor of 6, because the distance, or the DIFF, the difference between red and gray the day before was 4 points. The difference now is 26 points. So that's 6 times higher. And we use the 3x as the margin of difference. If you've got a difference in the lines that is 3x times, or 3 times the difference, then that will qualify as a significant movement in what we refer to as line separation analysis, or line separation differences. And that in itself does not identify a gap. It's a combination of additional things that identify it with it. Because think what has happened. The gray line in the zip gray, it only went up a little bit, whereas the red line went up a whole lot. So actually, if you look at it the day before, zip red being at 49, and now on this day with the vertical green line, zip red is at 89, the zip red line has jumped 40 points. And anytime you get a really strong zip gray line movement like that, it's just a signal. You may not necessarily know what the signal is, but it's a signal that identifies a really strong movement. A really strong movement. And so it becomes key to identify those movements, or recognize those movements. I mean, you can easily set your scan to print out those stocks that have a zip red line that's moved 40 or more points. I mean, you can range it, the zip lines that have moved between 40 and 50 points, and just look at what's going on with that particular stock. And so when you identify those things, you can pick up on that differences, or pick up on those positions. This example is an example of difference in lines. We obviously have key elements. The signal for the swing pink cross over the green line is a signal when and only when swing Zion is underneath swing pink. Because why? Because swing Zion is a price barometer, and the pink is a leading indicator. Swing pink is a leading indicator telling us that the values, or the indicator the swing pink indicator has just crossed over a major short-term trend line. And so that's why that becomes important in determining what we're seeing. And so we have the power Zion 2 days in between orange and green. Again, the vast majority of the time that leads to a gap up, but if it doesn't have any supporting conditions to go along with it, it could be a really minor price change. Okay. I mean, obviously, in the vast majority of times, again, it's going to go up. It's just it's not going to gap because of the difference. One other thing that I will show you here, I'm going to move the vertical green line over 1 day, and I want you to look at power white and power yellow. Power white goes up, and then on the right hand, and then after the vertical green line, white goes up faster. Power yellow goes up, and then after the vertical green line, it also goes up, but at a low angle, not a fast angle. And that's a divergent condition. Again, we don't see that very often, but that's divergent condition that we can count. There's one there. There's the signal between Zion, between orange and green. We have the pink line crossing over the green swing green line. We have the diff separation that's more than 3 times. In this case, it's 6 times when that's significant, and that would be exactly what we're looking for. And also, Zip Red did this by moving 40 points. And so, but look at what happened to the price. The red candle, I mean, we barely got a doji. I mean, we barely got any price movement. We've got a small red doji candle, and it opened above the 200 moving average. So typically when, like for example, on the day before the vertical green line, the green candle banged its head on the 200 moving average and didn't move. The following morning it opened above the 200 average, which is typical for when it's just going to continue to go up. But this is another one of those cases of what I refer to, and I call it a stagnation candle, or you might say a stagnant candle. It logically should have gone up significantly, but it never did. I mean, with 40 points moving on Zip Gray, and you get I mean, it opened at $12.50 and closed at $12.48. Think about it. Zip Red goes up 40 points, and the price goes down 2 cents. See, those tiny little differences are what it's all about. And that's why these sensitive indicators give us this information. They just alert us to things that are happening prior to the event occurring. And so there's many different situations that will cause a stagnant candle. But when you begin to spot them, I mean, you see, I mean, anytime you look at Zip Red going up 40 points and the price actually goes down, I mean, you really got price divergence is what you've got. So that's another form of divergence, and that's what I was leading to, because when we refer to DIFF, it stands for the difference, but when we refer to difference, we think of that as a divergent condition. And sometimes that gets confusing because some people will not think of it as divergence. They'll think of it as a line length difference, because remember, the two forms of conditions that we have to identify strength in a movement are line length and divergence. And so personally, we think of DIFF as divergence, but whether you think of it that way or not, it doesn't really matter. It just matters that you recognize that when you have strong indicator line length movements and a price that is going the wrong way, or it's just stagnant, then there's a really good chance that the following day it's going to be really strong, which is obviously the case here. And so several little signals. This is a little bit abnormal from what we might see or think about. You can also talk about this large pattern that we have inside, probably inside from the green line back to this line right here that you can see. I will take and draw in a vertical line so you can see which one I'm talking about. That between the vertical lines, excuse me, we basically have a big W pattern, but in the middle of it we have a high M pattern. And so if you think of the high M bottom, or the middle of the high M, as really going, just think of it if it was up, 20 points. So then you'd have, 2 days up and 2 days down. You'd have a really big BOC pattern. But in this case, we have what we refer to as a finished high M pattern, but within that we're really looking at what we would call a large W pattern between the two vertical green lines. And that large W pattern is finished in its capacity. In its capacity as far as it's being built. When that happens, you can typically think of a strong movement the same distance, or in other words, between the vertical green lines we have 6 days, and so you can think of the price moving up for 6 days after this. But in this case here, the second day it just went boom, and so all of that potential buildup of that large pattern that we recognize is the result occurring of what occurred here on the second day. I mean, I don't know what's going to happen. I mean, today right now is August 24th, 2017. As you can see from the, or maybe I guess I don't have it on the data window right now. But that's today. Excuse me. And therefore, as a result, we can see that that this pattern, with the specifics that I pointed out, I mean, we've got the difference in the divergence in the zip red and zip gray. You got the swing pink crossover. You got the divergence between power white and power yellow. That's very small. Also, as far as the big pattern is concerned, if you look under power pink, you've got basically a falling triple bottom. And it's evident, it's more visible possibly in swing Zion over here. Again, the high M pattern shows up really well here, and the W pattern also, but that just solidifies the view, I guess is what I'm trying to say. And if we go drop down to the power red, then obviously again you can see that we have a dropping or a falling triple bottom. And I think most people know that triple bottoms result in the price going up. When you have larger patterns, they react slower. And so this vertical green line here on the right is the finished pattern, but the next day it doesn't go up. We get a stagnant candle. And like I mentioned, it's the following day after that when it finally goes up. So that's the ideas that I wanted to convey on this particular indicator. The really nice gap up with a few different things to keep an eye out for. One of those things specifically was swing pink crossing over green, and then of course your 3x or your 6x times line differences, because there's several different ways to calculate line length differences.